Earlier this year, Chris and Scott tapped two seasoned professionals to co-manage the firm's rapidly expanding ventures unit. Without a doubt, Cody Crook and Drew Seaman have significantly advanced the ball for the company. That's a sports reference, move the ball down the field. Both Cody and Drew have quickly established themselves as two of the most sought-after consultants in M&A for executive search and human capital founders, and they formed the nucleus of a powerhouse team that has spearheaded some of the most prominent and visible M&A transactions in the industry. I would like to first introduce Drew Seaman, who in turn will introduce Cody Crook. Drew Seaman is managing director at Scanlon Ventures. He is responsible for co-managing the firm's investment portfolio of executive search, talent acquisition, private equity, and investment firms. In addition to overseeing a team that sources and analyzes new opportunities and investments, Drew leads the technical aspects of client engagements, including valuation and financial analysis, the build-out of data rooms, and the preparation of investment marketing materials. He manages a team of 4 talented associates. Drew began his career in wealth management before joining BMO Capital Markets as an investment banking associate in the Financial Institutions Group. Drew assisted with transaction execution and prepared comprehensive valuation and financial analysis for clients in the firm's specialty finance, asset and wealth management, and insurance sectors. It's a good segment. I get to see a couple of my colleagues and friends come on up here, and we start with Drew Seaman. Drew.
All right, thanks so much, Rob. I would like to echo Rob's sentiments about our last session, just an absolute dynamic presentation. Thanks to the Bespoke Partners team for their incredibly insightful content. I'm delighted to introduce our next presenter, Cody Crook, Managing Director of Scanlon Ventures, and someone who I hold in very high esteem. Not only are we close friends, having attended DePaul University together, where we played football on the varsity football team, but Cody is the one who enticed me to join Scanlon. It was a career move that I can personally attest has been incredibly positive and exciting. To be invited to be a part of a brand that is synonymous with executive search and human capital, and to sit at the epicenter of deal making in this sector was too good of an opportunity to pass up. It's been incredibly rewarding to be overseeing the fast-growing parts of the business, and the work we are doing is so critically important. Which leads me to what Cody will be discussing with you today: the process of structuring, negotiating, and closing a successful M&A deal. As Cody will reveal, it is part art, it's part science, with a huge amount of human psychology thrown in for good measure. But first, a little about Cody. Reporting directly to the firm's co-CEOs, Cody is responsible for co-managing Scanlon Ventures' M&A platform, where, as Rob attested in his opening remarks today, we've successfully closed a significant number of industry-leading transactions across the human capital sector. Cody started his career in recruiting and later joined Accenture as a business strategy manager, where he developed organizational and operating models and conducted M&A commercial due diligence for Fortune 500 companies. Following Accenture, Cody served as the head of strategy and operations at Hirewell, where he built a modern recruiting tech ecosystem and led multiple acquisitions. Cody earned a BA in English from DePaul University and received his MBA from the University of Chicago's Booth School of Business. It's my absolute pleasure to introduce to you Cody Crook. Cody?
All right. Well, thanks, Drew. And thank you, everyone. It's great to be here with you. As Drew mentioned, I'm very excited to talk to you today about a topic that's pretty near and dear to me, and that is how to structure a successful M&A transaction. So I think whether you're a founder who might be interested in selling your firm, or maybe a group of partners seeking to transition your business along a very well thought out exit plan, maybe you're a larger firm CEO who's looking to make acquisitions, or you're just simply sitting here this morning because you're curious about M&A, I hope you'll find this talk useful. But before I get into some of the tactical nuts and bolts of what goes into structuring a successful deal, I'd like to really set the stage by taking a brief step back and offering more of a wide-angle view of our sector and the human capital M&A landscape as a whole, and provide some context as to why this discussion on structuring a successful transaction is more relevant than ever. Over probably the past decade or so, really a wave of consolidation activity across our sector has profoundly changed executive search as we know it. And in the last 5 or so years, the role of executive search firms has fundamentally changed the look and feel of the sector even more. The industry has moved from simply identifying talent, which when you think about it is really just a single impact event, to managing a much more complex set of talent mandates around leadership development, assessment, coaching, interim solutions, culture fit, and people strategy. And this is a powerful shift that we at Scanlon Ventures believe will create a new paradigm for search firms in the coming decade and beyond. And in our view, the sector's best days are absolutely ahead of it. Search firms that are along this journey have gone through really quite a metamorphosis, bringing more tactical value to the table and playing an increasingly larger role as strategic people partners to an ever-expanding client base. And in many ways, for all of you executive recruiters who are here today, we feel that your moment has arrived. The tailwinds are strong, and it's an exciting time to be an executive recruiter. And so this shift in model, or this shift in approach, if you will, is leading to what we feel is one of the most extraordinary readjustments ever seen in the sector. And I think everyone from Shrek firms to small boutiques, everyone is really trying to figure out where they fit and how to capitalize on this once-in-a-lifetime change. For search firms that are fortunate enough to have significant financial backing, firms like Bespoke Partners, who we just heard from, ZRG, and Kingsley Gate, who are also here presenting at today's conference, and have attained their financial backing by way of private equity investment, the opportunity to rapidly expand with some very sophisticated growth playbooks is helping to fuel merger and acquisition activity like we've not seen in our sector before. And high on the target list of these buyers, and many like them, are specialist boutiques that bring a functional or industry-specific expertise or an adjacency that might help to strengthen an existing platform or help launch a new one, while others might bring offerings to help differentiate and scale. But suffice it to say, buyers are definitely flocking to the sector, and that's good news for founders and their management teams that are seeking to transition and looking for opportunities to potentially exit the business. In our view, the search industry as we know it is maturing, and yet that maturation of the industry is itself the catalyst that we're now seeing for change and really a rebirth. And that brings us to today. We at Scanlon Ventures believe that the human capital sector is standing at a very unique moment in time. I think no one from our perspective doubts that we're on the cusp of yet another period of very substantial growth and expansion, and we think much of that growth will be driven by M&A. And in our view, buying instead of building, or even selling instead of building, is the fastest, easiest, and most painless way to produce big results for both buyers and sellers. There are certainly inherent challenges in developing a proper, well-thought-out, and deliberate M&A strategy. And I think as Scott likes to remind just about every seller that we speak with, M&A is absolutely an emotional roller coaster ride that can be fraught with twists and turns and disappointment and even rejection. But I think more often than not, it does successfully conclude with gratification, fulfillment, and ultimately a closed deal. One thing that is for certain is that many founders and management teams that are starting an M&A process will be navigating some pretty uncharted territory. And so with that, let's dig into the structuring process, where I'll attempt to provide a bit of a roadmap and hopefully offer some helpful insight into what an M&A deal structure really looks like. And so we'll start with just a quick overview of the four kind of main components of a deal, and I'll talk about each of them individually at some length. And then from there, I'll talk more about just some key considerations I think you should be thinking about if you're approaching a potential sale or acquisition. And then finally, I'll leave a little bit of time at the end for Q&A. And so just one quick note before I get into this, and this was actually touched on by our last panel, but this definitely comes up all the time. And the point is that businesses in this industry are almost always valued as a multiple of EBITDA. And I think especially since private equity has come into the picture, revenue has diminished significantly in value relative to the bottom line. There are certainly some exceptions to this, and even we at HSV have recently seen some deals, even this year, that have been valued based on a multiple of revenue, but that is becoming increasingly uncommon. Almost always, I would say, the valuation multiple is tied to EBITDA, and I'll talk later about some of the key considerations you should be thinking about when approaching a potential sale as it pertains to EBITDA. But I would say for now, if an exit is on the horizon for you, definitely start focusing on either cleaning up or at least maintaining your P&L. And multiples can vary quite widely, but I think regardless of the multiple or the valuation, the total transaction value is typically comprised of these four key components. There are definitely some other slightly more exotic structures, and there are some other maybe less common components that can also be included in a deal. But I think these four represent the main sort of levers that you can pull when structuring a deal. And as you see, those are cash at close, earn-out, equity, and the fourth, which isn't technically part of the transaction value, but it is a very important consideration in an acquisition, and that's the go-forward compensation for the seller. And so when you hear that someone sold their firm for, let's say, $20 million, that $20 million is typically comprised of some amount of the first three, so cash at close, earn-out, and equity, to get to that total transaction value. Again, the go-forward comp isn't really included in that, still a very important component of the deal, which I'll talk about more in a moment. And so the first component of an M&A transaction structure is the cash at close. This is pretty self-explanatory. It's literally the amount of cash that is wired from the acquirer to the seller at the close date. And this amount can range from 0% to 100% of the transaction value. I think those are both pretty rare. It's usually somewhere in the middle. I would say typical range is probably between like 30 and 60%, but there is a ton of variance within that, and there are even a lot of cases where it's significantly higher or lower than that range. I'd also say that generally speaking, very broad strokes, but generally speaking, the greater the percentage of the transaction value that's paid upfront in cash, the lower the multiple, just due to things like time value of money. The seller is de-risking more at that point. The acquirer is actually taking on a bit more risk by paying a larger cash amount upfront, and the incentives aren't quite as well aligned over the long term. This certainly is not always the case, but I think it is important to keep in mind whether you're an acquirer or a seller when evaluating this component of a potential deal. In the cash at close, at least for us, I think it's almost always where we see the biggest disconnect between buyers and sellers. When founders are faced with the prospect of selling their firm, they want to monetize right away, and that's obviously very understandable. In many cases, these folks have built up their firms literally from scratch over a number of years or even several decades, and so they want to realize the maximum amount of value as close to the close date as possible. On the other hand, you have acquirers who want to incentivize founders and leaders of acquired firms to stick around post-acquisition and continue to grow the business. And so to do that, they will create a deal structure that rewards the seller maybe with less cash upfront and more of the deal value that's tied to an earn-out or an equity component, which I'll get into those more in just a moment. I think it's very understandable from both perspectives, but because of this disconnect, there's almost invariably a lot of time that's spent negotiating just this component of the deal structure. And again, it makes sense because for sellers, it represents potentially a lot to gain in one guaranteed instantaneous payout, whereas for acquirers, it represents potentially a lot to give up without a guarantee that the firm will continue to grow and perform at a high level after that initial potentially very large cash payout. And so again, this is just definitely something to keep in mind when negotiating a deal structure. The second component of a deal is the earn-out. And I think virtually every deal has an earn-out component. And the earn-out is just the portion of the total consideration that is paid out over a certain period of time, which is outlined in the purchase agreement. This is typically paid out in cash. It can also include equity. and it's paid out over a period that usually extends 24 to 48 months from the close date. I'd say a typical average or even median is around 36 months. The earnout can be simply deferred consideration that's essentially guaranteed. So for example, let's say an earnout is 30% of the transaction value that could be paid out in equal installments of 10% at 12 months, 24 months, and 36 months. However, the earnout is normally tied to a specific metric or KPI. And this metric could be revenue, it could be gross profit, it could be EBITDA. It could also be tied specifically to incremental revenue, GP or EBITDA generation post-deal close. Regardless though, the earnout mechanism is, or should be, I would say almost always is, very clearly defined and outlined in the purchase agreement. And it really functions to align incentives post-deal close. So let's just take an illustrative example. Let's say an earnout target might be $5 million per year in revenue over 3 years, and the annual earnout for the seller for reaching that target is $1 million per year. So if you as a seller meet exactly that earnout each year, you would then get $1 million in addition to the cash at close and any equity received as part of the deal consideration. The earnout could also be structured in such a way that you receive, let's say, 20% of anything beyond that target of $5 million in revenue. So if you have a great year post-acquisition, let's say you hit $10 million in revenue, your total earnout for that year would then be $2 million. On the flip side, there may also be some downside protection for the acquirer in the earnout. For example, if the earnout target, is again going back to this example, is $5 million, but you hit less than say 80% of the target, you might get zero earnout for that year. So if you only hit $3 million in revenue for a year, you could receive nothing for that year in earnout. However, as a counter to this, there could also be a catch-up clause that basically allows you as a seller to make up for a down year in a future earnout year, as well as some other more unique and sort of nuanced structures specific to the earnout. But this is generally how an earnout works. The earnout, like all components, is also a major negotiation point. But I think when it comes to the earnout, a lot of the negotiation has to do with setting the earnout targets appropriately. I think many times the acquirer will set the earnout targets pretty high, and I think understandably thinking that the acquired firm will continue to grow post-acquisition and benefit from some significant synergy realization. However, for sellers, this can be pretty daunting to have a significant portion of the deal that's tied to hitting, let's say, revenue or EBITDA target that might be greater than what they've ever achieved on their own as a firm pre-acquisition. So I think when it comes to the earnout, it's very helpful for both parties to really spend some time outlining what the potential synergies could look like realistically, especially over that earnout period, and then how this synergy realization will then inform those earnout targets. One other just sort of slight wrinkle to this is that an earnout could also be replaced or even supplemented with a seller note or seller financing, especially a forgivable seller note. And this is basically a loan from the seller to the acquirer that partially finances the deal and is paid back over time, typically with interest. But in the case of a forgivable seller note, the loan can be partially or even completely forgiven if certain targets aren't hit by the acquired firm post-acquisition. The seller note is definitely less common. We do see it from time to time, but it serves a very similar function to an earnout, basically tying the deal value or a component of the deal value to the acquired firm's performance post-close, and really incentivizing the seller just to continue working hard and producing desirable results post-deal close. And again, these are all illustrative examples. There are various ways of structuring an earnout, but this hopefully gives you an idea of sort of the general way in which an earnout works. The third component of the total consideration in a deal is equity. And so this is the portion of the transaction value that the seller receives in the form of equity in the acquiring company, or if it's, say, like a private equity buyer, for example, it could be that the seller simply retains equity in his or her firm post-deal close. In the former case, this usually comes in the form of an equity grant, meaning actual shares, so not options or RSUs or some other equity instrument. And typically, some amount of the total equity consideration vests immediately, while the rest will vest periodically over a certain period of time. This is similar to an earn-out structure where it could be 24, 36, or 48 months for the vesting period. I think in many cases, the equity component gives sellers the most heartburn when it comes to the deal structure, in large part because it can be sort of nebulous or even like pie in the sky, if you will, or just plainly difficult to understand. So I think when evaluating the equity component of a deal structure, it's important to consider a few factors. One, the value of the equity when it's granted. Two, the timing of the equity grants, so how it vests over time, either at close or over a number of months or even years. And three, how the value of the equity will either increase or decrease over time. And I also think that even if sellers do fully understand how the equity component works, a lot of sellers are a bit averse still to equity, at least at first blush, because it obviously carries more risk than cash. In the worst case scenario, the equity value could technically go to zero. However, the equity component also carries more potential upside, as there is also technically no upper bound or limit on the value of the equity. And this could lead to a very lucrative, quote unquote, second bite of the apple once the acquiring firm realizes its own exit at some point in the future. And so let's take another example. Let's just say a smaller firm is acquired by a larger firm for $10 million. And for simplicity's sake, we'll say the deal was a 50-50 split between cash and equity at the close date. So the seller receives $5 million in cash and $5 million in equity in the larger acquiring company at the close date. And so once the deal is closed, both the acquirer and the acquired firm get to work on integrating, realizing synergies, and rapidly growing the firm as a whole. If the buyer then has an exit or liquidity event, let's say in 5 years from the time the acquired firm is acquired and the equity value of the larger firm has increased, let's say 5x over that period, the seller's equity stake that was granted at the close date would then be worth $25 million at that liquidity event. And this is obviously significantly more than the initial consideration of even their own acquisition. So yes, absolutely, equity consideration carries more risk, but there's obviously a lot of potential upside with equity as well. And so just to kind of quickly summarize this, the equity component of a deal is, I think, really ultimately an effective way for the buyer to align incentives with the seller and motivate the seller to help the whole business continue to grow post-deal close. And it can lead to significant value realization for both parties, which I think is an important thing to keep in mind. Okay, and then the fourth and final component to a successful deal, really any deal, but hopefully a successful one, is the go-forward compensation for the seller. And again, I touched on this earlier. This is not really included in the total transaction value, but it is a very crucial consideration for both buyers and sellers when structuring an M&A deal. And so the go-forward comp is simply what and how the seller is getting paid on an annual basis under the acquiring entity. And this was also touched on in the last panel, but the reason why this piece is so important is because oftentimes founders and leadership teams of acquired firms have to transition from paying themselves, maybe a quarterly or even an annual profit distribution and maybe little to no base salary throughout the year, to a more formal compensation structure that includes a more normalized or reasonable base salary plus a bonus and or a commission plan. This is also hugely important because the go-forward compensation directly impacts the adjusted EBITDA figure of the target firm, which then informs the total deal value when applied to an EBITDA multiple. So if a seller wants to be paid a really high base salary under the acquiring firm, the trade-off is that this will apply a big hit to the adjusted EBITDA and thus the total transaction value. On the other hand, though, a strong go-forward compensation plan for the owners or the sellers of the firm can also make up for any perceived shortcomings in maybe the other three components of a deal. I think oftentimes this component is overlooked in a deal, at least at first. One, because it's not part of the deal consideration, so it's literally not included in the equation for transaction value. But two, because I think sellers who are often founders haven't really had to think about what their boss is going to pay them in terms of salary and commission structure because they haven't had a boss in so long, or maybe ever. But it is hugely important because in most cases, the seller is going to remain with the acquiring firm post-close for some period of time, whether it's on the short end, 6 to 12 months, 24 months, 36 months, or even longer. Could be an indefinite period of time. And because of this, the go-forward comp should be weighed heavily and carefully as part of the total deal consideration. And so this brings us to, again, just what I think are some key considerations you should be thinking about, particularly as a potential seller, but I think this is also important to think about if you're acquiring a firm too. First of all, when you as a seller are approaching a possible sale, think about how your firm dynamics and economics may change under new ownership. For one, you as the CEO/founder will have a boss for the first time in a long time. Are you and the CEO/founder of the acquiring firm aligned philosophically? Is there a good culture fit between the two firms? Do you see yourself being able to work well with the leadership of the acquiring firm over the next 2 to 3 years at a minimum? Will your employees and partners get along well with the employees and partners of the acquiring firm? The answers to all these questions can lead to a lot of value creation or destruction. Some other things you should be thinking about. Will the commission/payout structure change for your employees? And if so, how will this impact the bottom line? Are commissions and distributions paid monthly? Are they paid quarterly? Are they paid annually? And how will this then impact team morale and motivation if this is a change under your ownership? What types of top-line synergies are able to be realized? Are there significant cross-sell or upsell opportunities that will improve revenue without adding on a lot of incremental cost? Said another way, are there ways in which 1 + 1 will equal 3 or 4? These are all important things to be thinking about when it comes to firm dynamics and economics post-acquisition. Secondly, I think you have to understand what's important to you as a seller in a deal and how the resulting deal structure may impact total valuation. I touched on this briefly earlier, but I think if you're expecting the majority of the deal consideration to come in the form of just one large sort of lump sum payout at close, this could result in a lower overall transaction value than if you agree to something that has more consideration tied to an earnout and or an equity component. So start thinking about those trade-offs between the deal structure and the total valuation. I think it's also really important to think about things outside of just the financial component. Yes, that is hugely important, priority number one for sure, but there are other things to think about besides just the financial piece. What type of firm, for example, do you want to sell to? Do you want to sell to private equity? Do you want to sell to just a larger firm? And then how will these criteria, in terms of who you want to sell to, potentially accelerate or delay a deal getting done? I think you should also be thinking about what your role as an owner or seller will be post-deal close. Some founders continue running their firm more or less business as usual, post-close and upon being acquired, whereas others may gradually take a step back over time. And so your role and thus the resulting compensation that you command, depending on your role, can also affect EBITDA and again, thus valuation. So this is just another really important thing to consider. And finally, I would just say that if you think an exit is in your future, maybe not immediately, but at some point, it's never too early to start preparing for that exit. If you get to the point where you're ready to retire and you're expecting to have just a very quick and easy sale process and then go sit on a beach somewhere in a matter of like a month or two, I think you're probably in for some major disappointment. The M&A process, from the point where you begin speaking with potential acquirers to a deal close, can take a while. But there are things you can do ahead of time, or at least start doing ahead of time, that will make the process go more smoothly once you get to that point. For example, make sure your financial statements are clean and readily shareable. I can't stress the second part of that enough because sharing of data and delays in sharing data can really slow down a deal process and life cycle. As part of cleaning up your financial statements, you should go in and flag any personal or legitimate one-time expenses that could actually be added back to the P&L to get to a more realistic adjusted EBITDA figure. If your accounting is done on a cash basis, which I think is the case for a lot of smaller firms and boutiques, you should start thinking about maybe transitioning to accrual accounting or at least tracking your accounting on an accrual basis Because a lot of sophisticated buyers, both strategics and private equity firms, will want to review your financials on an accrual basis because that's how they account for their books. If you as the owner are heavily involved in the day-to-day operations of the business and you want to remove yourself post-deal close, and maybe you don't want to stick around for an extended period of time, you should start removing yourself from the day-to-day now and putting processes and systems in place into the business that will make it more robust to a change of ownership, less reliant on you individually, and ultimately more scalable and supportive of growth post-acquisition. This will also make your firm more attractive and desirable. It can actually lead to a premium on the valuation multiple. And just lastly, in terms of preparation, I would just say to set your expectations appropriately. Again, can a deal get done very quickly? Yes. Is that always the case? Definitely not. There are a lot of things, when you think about it, that have to go right in order to get a deal done. You have to find the right buyer, then do some initial information sharing. Then you have to agree to an initial purchase price and negotiate the deal structure. Then due diligence kicks off, which is a totally different animal, which can take 3 months plus potentially. Concurrently, a purchase agreement has to be drawn up and agreed to. All the while, multiple parties are in communication to facilitate the deal. Founders, partners, brokers, bankers, lawyers, accountants. It can be a little like herding cats. And also, don't forget, throughout this entire process, you also have a business to run. And this can become a major distraction if you're in the process of potentially selling your firm. So again, I think the more you can prepare yourself and ready yourself and your business beforehand, the better off you will be when it actually comes time to do a deal. And so with that, happy to take some questions over the next 10, 15 minutes. Sure.
Pat Harrow, Green Economy Search. You didn't mention anything about tax structuring or capital gains, and I'm starting to wonder. You're talking about seller financing, long earn-out periods. Sam mentioned single-digit valuations. Is this even worth it? I guess would be my question.
Yes, absolutely. In short, there are certainly important considerations that we're not experts on when it comes to capital gains versus ordinary income tax, and what the multiple actually ends up being. And again, the multiple can vary quite widely, and it depends on a lot of factors. A few of which were covered in the last panel. But yeah, I would say it's absolutely worth it. Especially, when you think about it, if you're an owner or a founder, and you're getting to the point that you want to retire and exit, and you don't have a succession plan in place internally, you don't have partners or even like family members or someone who's like ready to step in to that role, I think it's certainly a better trade-off to sell the firm at the right price, and get the right deal value, as opposed to just continuing to work or potentially winding the firm down. And unfortunately, we do see that from time to time. So absolutely, and I think this is a great point that you bring up. This goes into sort of that preparation leading up to a potential sale, and some things that you for sure should be thinking about. Again, not that we're necessarily experts in, but there are certainly folks who you can consult. But yes, absolutely, I think it's worth it at the right price. And maybe your firm is taking a downturn in the economy, for example, harder than some other firms, and so you may want to wait a year or two to see if the market comes back, and you can get a better valuation multiple. Maybe capital isn't so expensive. So there are all kinds of considerations. But again, in short, absolutely, I think it can, and most of the time is worth it to sell your firm at the right time and for the right price. Sure. Yeah.
Mary Claire Garber, Princeton Legal Search Group. When you were talking about the considerations and you were talking about my word, not yours, infrastructure processes, are you talking, or are you referring to, I can guess, but I'd rather hear it from the expert, are you referring to processes in terms of procedures, like when we bring in a search, these are the 5 steps that we follow? Or are you talking about processes in terms of here's the technology that we're using to generate a pool of candidates? Were you talking about processes in terms of others? If you could speak a little bit to that, what specifically are companies looking, investment firms looking at?
Yeah, for sure. I think it certainly is both of the first two that you mentioned. And I think it may be a bit taken for granted, but some firms don't have much process at all. Maybe it's a few founders or a few partners, and they just have a really strong sort of Rolodex or just network of both clients and potential candidates, and they just sort of run the business that way, and there's not much else behind it. And so when it comes to a potential exit, a buyer is, I think, much more attracted to a firm that is not so reliant upon just one or two or three people, and is more robust to changes in ownership or changes in the economy, or just general sort of market conditions, if there are more, I won't say rigid, but just more sort of structured processes in place. That doesn't mean that you have to become a technology firm or develop some crazy AI software like in-house. I think if you have the capacity and the capital to invest in those things, it's great, and that can lead to a premium on potential valuation multiple. But what I'm talking about when I talk about just processes and systems is exactly what you said, just like a very well-defined, almost step-by-step equation for how you operate the business. And if technology is a part of that, which I think it probably should be, at least in some form or fashion, that's great and it's helpful. And again, I think technology just helps to make the business more scalable and supportive of growth after an acquisition is completed. But at least I think table stakes have to be just a very well-defined sort of operational plan for how the business is run on a day-to-day basis, and then how that informs growth moving forward.
So then training is also part of that consideration for how you bring people in and on board.
For sure, and this could be an entire separate presentation probably, but I think training is especially important. I mean, we talk to firms every day, throughout the week, and I think everyone is maybe not struggling, but at least it's becoming tougher to find rainmakers and big billers and top producers. And so I think part of maybe the issue or the struggle is that there has been, as a whole, not any individual firm, but as a whole in the industry, maybe a lack of focus, or even just kind of taking the eye off the ball in terms of training young people, even out of undergrad, and bringing them up organically through the firm so that they're ready to one day become a partner and top producer. So absolutely, if you have a really solid training program in place, and you're able as a firm to bring young people, maybe not even fresh college grads, but like less experienced folks into your firm and grow them organically into those top producing roles, that's a huge asset and a huge benefit.
One last follow-up.
Yeah.
In-house, out-house, or in-house, outsourced, in-sourced training, does it make a difference one way or the other?
There are certainly a lot of considerations, I think, when it comes to bringing something in-house versus outsourcing it. It's hard to say in one sort of blanket general statement. I think it totally depends on your firm, your capacity as a firm, any expertise or sort of core competencies that you have in training or development in terms of your own people. So it's tough to say. I think you really have to take that on a case-by-case basis.
So it depends.
It depends.
It
That's the
depends.
worst answer, but it's true. Yeah.
Got it. Fair enough.
Chris Holmes, O'Connell Group. So question for you. We're niche, we specialize in a certain area, but our clients are constantly asking us, do you work in manufacturing, supply chain, whatever? So
Yeah.
our value could be, we could bring in businesses or jobs in a lot of different industries that we don't cover. And so what's the value of that, and what sort of multiple could we get bringing in lots of jobs that we don't cover?
Yeah, for sure. So I think, again, going back to the panel before this, which was great, I think diversification of revenue streams in general is great, and it's a huge asset. That being said, it shouldn't come at the cost of your core business. And so if you by taking on those, like different industries, or, for example, a lot of executive search firms don't want to go below C-level. They won't do C-1 or C-2 because that's not their expertise. That's not their core competency. And I think in a lot of cases that's actually wise. So if you have a strong balance sheet, if you have the capacity internally to diversify revenue streams, even from an executive search standpoint, just get into, as you said, like different industries. If you're able to do that in a sustainable way and it actually benefits the business, absolutely, I think it's a good move. But again, it depends, and I think it is truly a case-by-case basis on the health of the firm, the capacity of the firm to be able to do that organically. But this is another instance where I think M&A can actually really help, because if you buy instead of build, and you buy a firm that does C-1 or 2, or that specializes in biotech or manufacturing or whatever else, you automatically and immediately are now experts in those spaces as well, and you haven't had to spend a lot of money, maybe wastefully, internally, building those capabilities on your own.
Yeah. Sorry, John Goodrum with Pring & Associates. You touched on it earlier, and I guess I'm thinking about the valuation within the pandemic. So you had a lot of winners, you had a lot of losers, and you had some in between. If you're an investor right now into this space, are you throwing out those numbers? Are you averaging them out? Are you saying, well, let's go look at 18, 19, 20, and then 22, and then obviously 23 is coming up here shortly? Or is it no? How are investors looking at the pandemic numbers?
Yeah, it's a really good question. I was literally just chatting with someone before the session about this. I don't think you can just disregard performance during the pandemic. I mean, it happened. It was obviously hugely unfortunate. I think for a lot of businesses that were exposed to industries that took a huge hit in the pandemic, they suffered financially during that time. So you certainly can't write it off. And I think investors are looking at that. If they say, if they see that a firm is exposed to these types of, black swan events, and that can really derail business, even for a short period of time, that will give them pause and potentially cause for concern. So again, this kind of goes back to diversification of revenue. It can be tough to do that, but if you have multiple revenue streams, even from different industries or different offerings, that will make you as a firm more robust to a potential downturn. So I think a lot of firms, in terms of investment firms, certainly appreciate the fact that COVID was unprecedented, and hopefully we won't see anything like that ever again. But at the same time, you can't just disregard 2020 and 2021. Even if your firm had a really great year, I think that might even be sort of tailored back a bit if after post-pandemic your firm kind of comes back to earth a little bit. So again, you can't write it off, but I think there are things you could do to hopefully make your firm more robust to these types of sort of crazy black swan type events. Sure.
John Buggy, Palmetto Pivot Partners. I have a question regarding post-acquisition integration and how much do you prioritize some of the plans around post-acquisition integration into your forecast of EBITDA? And then secondly, as part of the process that you described, do you also get involved in the preparation of that successful post-merger integration that would be key to the longevity of the deal?
Yeah, for sure. We will absolutely get involved as much as a potential seller wants us to. I think a lot of cases we'll work with a firm or a founder that's looking to sell, and they'll already have a pretty well thought out succession plan, and so we don't need to get as involved. In other cases, they may have not thought of it at all, and so we can bring some advice and advisory to the table, and at least at a high level, sort of help some firms out that are looking to transition but haven't really thought out much of a plan. In terms of integration, I think, and Pat at ZRG talks about this a lot, I think a good sort of default is to have a first do no harm approach to integration. And that means acquire the firm, but don't do anything crazy right off the bat. I think take some time to get to know each other, identify more specifically and more pointedly where some synergy realization could occur, and do that certainly with a sense of urgency, but there's really not a huge rush. I think private equity is a little different because they do have an exit window. At the same time, though, with private equity, they typically have a really strong growth/integration playbook, and so they maybe are more adept at integrating a firm and creating that 1 + 1 = 3 or 4 more quickly than maybe a strategic would. So absolutely, these are huge considerations and things to be thinking about, but I don't think it all has to occur at once, like at the close date. We probably have time for one more. Okay, yep.
Thank you. Janice Alec, Alec Group. How does real estate play into the valuation? Say you've just signed a 5-year lease, 10-year lease, or whatever. And also, do you have to be there after, say, 3 years if the equity is realized in 5 years?
Yeah, I mean, if you're on the hook for a lease, you're on the hook for a lease, and there's not much you can do about it. I think that's becoming less of an issue now. I think there's been a huge, or at least a significant push to return to office, and so folks are going back to the office more and more, and so like that office space is more required. I think in like 2020 or 2021, if you had just signed a big lease, maybe that was a big red flag on on a P&L. But I don't think that in today's sort of environment, having real estate is a huge consideration, because I think a lot of firms, if not most firms now, are going back into the office, at least in a hybrid way, and so you still need office space to do that. And then sorry, what was the second part of your question? Oh, sure, yeah. So I think and I would consult experts or look at the specific sort of deal structure. But as your equity vests, it is yours. And so if you are contractually obligated to stick around for 3 years, and that coincides with like the vesting schedule of your equity after 3 years, you're probably okay to transition out. I mean, I would suggest putting a really thoughtful transition plan into place. But yeah, I think as long as your equity has vested, that's your equity, regardless of if you're full-time day-to-day involved in the firm or not post-acquisition. All right, well, thank you.